Oh, hello, it's Susie from Esoteric Trading Solutions. I hope you're all well. Please be kind to yourself. Please be kind to your family and your friends. Please be kind to your putty cats, your beautiful dogs, any other animal that you have. And please be kind to people just generally in the world to make this place a better place. Thank you. Today I'm going to talk about investment themes, and it should be fairly interesting insight. This is not personal financial advice. It's just what I look at in terms of the market and what I think could possibly play out this year for my own investment strategy. Thank you. Oh, hi everyone. I hope you all had a great Christmas and a great and safe New Year. I thought I'd just start, and I know it's only the 2nd of January, but I thought I'd just start with the investment theme for 2019 and looking at all markets. Just from my perspective, this is not personal advice or anything else, but this is pretty much how I see markets at the moment, just starting for the year, and this is how I'm viewing markets at this stage. If we go to cash, the cash rates, global cash rates have been rising in the last couple of years particularly. And you see, obviously Australia's cash rates are 1.5%. We haven't risen. Our rates haven't rose. We haven't put up cash rates in terms of the Reserve Bank of Australia. But there have been changes across other countries. As you can see, Argentina up, Brazil, China, just going through Mexico, the US, of course. I think the US is higher than that. This doesn't seem to be right. It's updated. Yeah, so you get the general idea. The US rates are around 2.25%. So generally, we have seen cash rates going higher as a rule of thumb. On the bond market side, which is the longer end of the yield curve, bonds generally have been rising, and you'll see that with the US rates, you'll see that with the Mexican rates. Other countries have come off a little bit. But generally, as a theme, bond rates have been rising. Italy has gone up. The UK has gone up generally as a theme. Greece has gone up. Certainly, Australia bond yields have gone up as well, generally as a theme as well. So that's also, if we look at another subcategory of interest rates, high yield is going up in yield rates, interest rate yields, and it's coming down in price. So don't forget there's an inverse relationship between interest rates and price. So a corporate bond, if interest rates are going up, it means the price is going down. You buy something for 100, interest rates rise, it's going to be worth less than 100. Okay, so generally as a rule, cash rates and bond rates are going up. Yield curves were inverse. In other words, the yield curve, the longer end of the curve, was much lower than the short end of the curve. We are starting to see yield curves become a bit steeper. In other words, the long end of the yield curve is starting to rise quite a lot, and we have seen that in the US, particularly in the 10-year bond rate and the 30-year bond rate. Okay. Also, don't forget, with quantitative easing, we saw negative yield curves in Europe and everywhere else. That quantitative easing seems to have finished, and the Fed certainly is not doing any more quantitative easing. As you know, interest rates are rising. They have a whole heap of assets they bought in 2008 to stop the market from completely collapsing. They are looking to sell down their bloated balance sheet, and their balance sheet is very bloated. It's got something like $4 to $5 trillion worth of fixed income assets that they want to sell down. If they're selling down fixed income assets, it means price is going down, means yields are going up. So it's not great for the fixed interest cash bond markets overall, or for the mortgage-backed security markets or anything like that. So interest rates will tend to rise, and obviously prices will tend to come down. Now, this monetary expansion of stimulus that we saw in the cash system, particularly from the US and from the UK and from the European Central Bank, is coming to an end. And even in Japan, it looks like that. Globally, this stimulus of cash being plowed into the system is stopping from quantitative easing. And that's also going to put pressure on things in terms of how much money is in the system. Now, consumer price index, or the inflation is rising. There is no doubt about that, even though it doesn't reflect in the figures. I actually don't believe the figures that are produced. Inflation is in the system whether you like it or not. If you look at food price inflation, if you look at rates, if you look at housing prices, particularly here in Australia, if you look at utilities, electricity, gas, all those basic things in life are all up. If you have children, sending them to school is getting more and more expensive. Healthcare cover is going through the roof. Car insurance, everything. I believe inflation is a lot higher than what the governments and the statisticians are actually printing, and I think that's erroneous. And with that, bond rates, interest rates should be a lot higher as well. There's no doubt about that. And the longer end of the bond yield curve, interest rates should be much higher than the short end of the cash curve, making it a positive curve where you've got the 10-year bond rate being higher, obviously, than the cash rate. So I believe that inflation is here to stay and it will rise, and it is rising, and the figures aren't being properly recorded, and I think they're telling us a lie. Also with that, if you have lower growth, it's not a great story for equity markets. Higher inflation with lower growth is quite negative, plus higher interest rates is very negative for the equity market. So if we go forward, looking at the equity market, higher interest rates will bring the equity markets down generally, because equities are priced off interest rates. And look, they're priced off other things as well, and there's so many things they're priced off. But the reality is, if interest rates are rising, the net cash flow from equity markets actually comes down. It's quite bad. Also, trade restrictions, we're starting to see that globally, where there's protectionism. In other words, the US, through Trump's policies, they're trying to protect US industry. That is not great for the rest of the world that exports, particularly China, that exports a lot of their product to the US. It actually reduces the growth in China. China need a GDP, or a gross domestic product, which is growth within their country, of 8.5%. Currently it's running at 6.5%. If they don't get that growth, they can't take people out of the country areas, in the peasants, with economic growth into the middle classes. And they need 8.5% to do that. So in other words, they can't grow most of their economy in terms of more income, more factories, more growth in terms of factories and work and this sort of thing. So with protectionism, it means that Chinese will not be able to sell the produce or the products that they actually produce, which means they get less revenue. They can't plow it into their own country. It means they can only buy so many US dollar treasuries, and they may even start repatriating some of that money back to China. In other words, selling US dollar treasuries and converting it back to the Chinese renminbi or the yuan. So protectionism globally is a very negative thing. We saw that leading into the Depression in 1933 economically. It's a very, very bad thing because it actually stops world growth. The US equity market, in my mind, is just way too high. With most stocks in the US market, there's been massive cost reductions, but if you look at the revenue lines for those stocks, they're not increasing. They've increased their profit, but by doing that, they've increased their profit by reducing costs, but not actually increasing their revenue line. Also, the price earning ratios for the US market, in my mind, is just way too high, given that there's been no revenue increase, generally as a rule. So these are the themes I look at. Look, there's a lot more, but the thing is, I just want to try and cut it down because there is so much stuff to look at. And, I'd be here for a day trying to explain everything to you. But as far as I'm concerned, the Dow, which is the 30 top stocks in the Dow index, and it's the most well-known of all the US indices, this thing, when leading to 2007, it was basically around 14,500, right, as an index, which means, all the stocks in that index contributed to about 14,500 for the index. When the crash came in 2008, that Dow got down to 5,800. Okay, this is only back to, 2010, but you can see this has been parabolic, absolutely parabolic. Now, if you put a line straight through that, you'll see the Dow has basically finished its uptrend. It's a shame I can't draw on this, but you've got a double top up here, big double top, and basically this thing looks like it wants to come down to me quite a lot. Now, it could come down, I'm in my mind, 10,000 points quite easily. The market is so overextended, and the why it was so overextended is because the interest rates were negative. Basically, what that means is the bank, if you borrowed money from the bank, they would give you interest back. So all the big wealthy people who could borrow money at the bank from negative interest rates would basically invest in anything else that gave them more than negative interest rates. And that was also high yielding stocks in the Dow, okay, with dividends and whatnot. And that's pretty much what's pushed this market way up, you know, with cheap money. Now, this is going to come down, and it could come down quite a lot because it's very, very overextended, as you can see. And we've got basically a double top here, a parabolic sell and a parabolic sell, and it looks very negative to me indeed, very negative. And basically the fundamentals also are telling me the same picture, which I just went through before. If we go to foreign exchange markets, basically we've got the US yen here, US dollars against the yen. It's a spread trade. If you sell US dollars, you're buying yen. If you're buying US dollars, you're selling yen. Okay, now the US dollar has been in a high, it's been going higher and higher and higher since around 2012, as you can see up here. And it looks like it's suddenly come down again. We've got this parabolic sell here. This is the 200-day moving average. So yes, it's still in its uptrend, but the highs are getting lower, and that's concerning. Now, if they sell US dollar treasuries, which are in US dollars, it means they're effectively selling US dollars, okay? So overseas investors that are in the US dollar market will be selling US dollars if they start selling US treasuries and going to cash and then bringing that back to their domicile country. So say if I'm an investor here in Australia and I hold US dollar equities, I'm going to be selling US dollar equities as well as selling US, and I'm going to bring it back into Aussie dollars. So I'm effectively selling US and buying Aussie dollars. This thing, to me, looks like it can head down much lower. And that would be consistent with my theme of selling US equities, okay? The US equity market comes down, they will sell US dollars. There's no doubt about that. And basically that makes sense because when you get US equities coming down, all the market goes to safe haven currencies, and the Japanese yen is a safe haven currency. In other words, it doesn't move down as fast as, say, the US dollar when the US dollar equity market is coming down. So if we go to the next slide, we got pound US. Now that's an interesting story. Since Brexit, we don't know what the devil is happening with Brexit. It's very bad because the English are actually out of the European Union, and, you know, God knows what's happening. A lot of companies have moved out of England and they're going to Europe, and I've noticed they're particularly going to Amsterdam and other countries, even Holland. Now, this is a 200-day moving average on a monthly, and this thing could go much lower. It's basically the uptrend is broken and it's just going lower and lower and lower. So in other words, the pound is going to underperform the US dollar. Even though the US dollar is selling off, the pound is going to underperform because there's still so much uncertainty and we don't know what's going on with Brexit. You know, does it mean that the English need a passport to go to every other country in Europe now? And what does it all mean for the Irish border and everything else? Do the English stay out of that, or do they still try and control Ireland? And they just cannot seem to get any agreement around the Irish border. So watch this space. But technically, the pound looks terrible. And it looks like to me it can go a lot lower, maybe even 1-to-1 to the US. And that's a big call, but potentially it could. Okay, so if we go to the Aussie dollar, if we go to Euro, the Euro US, again, this is a very interesting story as well. The Euro, if you look at it, it's bottomed here, and bottomed here. And since 2015 to 2017, it's done a lot of bottoming against the US dollar. It looks like it's trying to get into an uptrend. It hit that 200-day moving average and came back down again, but now it looks like it might try to move up higher. So basically, for the euro to be bullish against the US dollar, technically it needs to break up above the 200-day moving average. Okay, so it's done a lot of bottoming against the US dollar in the past, since 2015 to 2017, around 103 roughly, 103, 104. And now, you know, got up to roughly about 126, came down, now it's 114, 1.14, and now it's trying to break up again. So it'll be interesting to see where the euro goes against the US dollar. If we take it to the next slide, Aussie dollars. Aussie dollar, generally a selling of Aussie against US is a risk trade. If I sell Aussie, I'm buying US, okay? And generally selling the Aussie dollar is a risk off trade. If I'm bullish the market overall, every market I will buy the Aussie dollar. But generally as a rule, it's a risk off trade. As equity markets start to implode and everything else, generally Aussie dollar will underperform the US dollar. You know, the US gets a sniffle and we catch a big cold, which is really annoying. But anyway, as you can see, the Aussie dollar is under the 200-day moving average, which basically is a big indicator for a change in trend by the professional traders. And I use pivots, as you know, which the professional traders use. Still got a sell on this, a parabolic sell. It is getting towards its lows, but if you look back on this chart, 2009, when the equity market was at its worst, remember the equity market sold off again in 2009, the Aussie got down to 0.6194. Now, potentially, if it breaks this level around 68 cents, it could go there. So this is going to be interesting to see where Aussie dollar goes, that's for sure. If we go to the US Swissy, and I'm looking at the currencies that have the most liquidity, okay? Basically, what we've got here is the US Swissy is right on this 200-day moving average. If anything, it's just come down a bit, okay, which means they're selling the US dollar against the Swiss franc. Now, the Swiss franc is a risk-off trade. It's basically a safe haven currency, just like the Japanese yen, just like the Scandinavian currencies and that sort of thing. Okay, so it's a safe haven currency. Okay, so that does not surprise me that we're seeing this. As this goes down further, it means the US dollar is getting sold off because they're selling US and they're buying in. As this goes down further, they're selling US dollars and buying, Swiss franc. Okay, now that's very interesting to me. Very interesting. It's got up there and it can't get through and it's getting sold down again. That's telling me to sell US dollars against Swiss franc, and it is a risk off trade. Okay, we'll go to the next slide. Right, so FX themes, selling US and they're buying yen. Yen is a risk off trade to buy yen. Selling Aussie dollar and buying US dollar, they just expect the Aussie to perform worse than the US. They're selling pound against US, they're expecting the pound to perform worse than the US. They're buying Swissy against US dollar, and it looks like euro may go higher, but again, the jury's out because it hasn't gone through the 200-day moving average. When we talk about risk off trades, where risk is, rising and people go back to, US treasuries or whatever, and they want to get out of the equity market, they sell Aussie, Canada, and they buy yen, Swiss franc, and Scandinavian currencies, generally as a rule. Okay, and they do sell US as well. Now, don't forget, all these are spread trades. Pound against US, Aussie against US, all those sort of things. It's a relative trade, whether the Aussie performs better than the US or vice versa with risk off. Generally, the Aussie will perform worse. Generally, the pound will perform worse than the US. But the reality is the safe haven currencies like yen, Swissy, and the Scandinavian currencies being NOK or, what else we got there? NOK, we've got the Swedish krona and those sort of currencies. They all, and the Norwegian krona, I think it's called. They all perform quite well. And also what we do find with foreign exchange, emerging market currencies like the Indonesian rupiah, the Indian, rupee, those underperform very badly. And so, for example, so does the Mexican currency against the US. So any emerging market currency performs very, very badly in times of crisis, i.e. like the Turkish lira, for example. You expect those to fall harder than the US dollar, for example, which is not surprising because they're risk trades. Okay, so we go to the commodity market, and I've only looked at the hard commodities, and I've only looked at two, oil and gold. Okay, there's a whole lot of soft commodities, and they can be wheat, they can be pork bellies, they can be orange juice futures, you name it. I haven't looked at the soft commodities, and that's what they call them. I've only looked at two hard commodities, which is oil and gold. Okay, now oil, interestingly enough, 200-day moving average, the uptrend is over. Oil is going lower and lower by the looks of this, and that's also in theme with what's happening globally. You know, they're developing new cars that are on electricity and, you know, better ways of doing things and not using as much oil. So that makes sense. There's a big supply of oil, and it makes sense because the demand for oil is not as high as it used to be, because now we're finding better ways to do things and not pollute the planet as much, which is super as far as I'm concerned. Also, you know, a lot of cryptocurrencies are working on, you know, carbon, you know, how to get rid of carbon and this sort of thing from using polluting cars with oil. So it looks like oil in this theme of things could probably easily, well, it looks like this to me, 27 cents, something like that. So it doesn't look good for oil. If we go to gold, the chart is very different. Gold is still in the uptrend, provided it doesn't break the 200 moving day average, which it looks like it's about $1,200 US dollars against the US dollar, gold US. Even though we're going to sell here, it has to hold the $1,200 price, and it has to hold that 200-day moving average. Otherwise, the trend is down. Trend's still up, and you know, gold still looks all right, providing it doesn't break that. So if we go to the next slide, oil down, gold up, and that's consistent with a rising inflation environment. Very inconsistent. You'd expect gold to go up when you've got rising inflation. It's a hedge against inflation. Okay, you'd expect that, and that makes sense to me economically. If we go to the fifth asset class, crypto, which is the newest asset class, as you know, and I don't need to go on too much about this, this is XRP. You know, the asset classes for crypto have been smashed. A year and a half ago, let me think, not last year, the year before, December 2017, the market capitalization for cryptocurrency was 880 billion. Now we're talking about the market cap of overall being about 128 billion. So it has come off so much that it's a joke, right? And you wonder whether they can push this thing down any further. I don't think they can. And if you look at the charts, and look, you know, I know, you know, the story is fundamentally everything about XRP, which I love, but also if you look at the charts, technicals are lining up as well. You know, we've got, you know, it's been so oversold. You know, anything at this level now is just basing. You know, the market is basing. You know, this XRP is basing. You know, and basically it's having trouble, you know, breaking down in any further, which tells you this is a market primed to start moving up. You know, I've seen a lot of technicals in my years of trading markets, and this has done a lot of basing around 30 odd cents, and you know, it's basically basing, and it's going to move up. The longer the base, the higher the high. Pretty much that's what they used to teach us as traders when, you know, I was in my 20s. So the longer the base, the higher the high. That's pretty much the story. So certainly XRP has been basing for a long time. If we go to Bitcoin, the next slide, again, we've still got this situation. And again, interesting enough, with Bitcoin on the weekly, it's still holding the 200-day moving average. Now, the market has come down, yes, a lot. And we got this parabolic sell here. My system gave that to me, then gave me a buy, and then it said to stay out. But the reality is it's still above the 200-day moving average, which means for the big trend, even though Bitcoin's had an incredible range, excuse me, it's still in an uptrend. And this basically is starting to base. And again, the longer the base, the higher the move up. And I get to the feeling that you know, it's getting harder and harder to sell Bitcoin down here, because don't forget, you know, there's only 21 million of them, and 17 million odd have been mined already. So it's going to become a supply issue, a lack of supply, regardless of whether it's slow, the technology, or whatever. Bitcoin will become a lack of supply. Plus, when the sheep out there, you know, the 99% of people out there know about cryptocurrency, the first thing they're going to buy is Bitcoin, because they know about it. It's the poster child, if you want to call it that. So the reality is it's still in the uptrend, even though it's had an incredible range, and it looks like it's just incredibly oversold to me, just looking at that chart, like XRP pretty much. So if we go to the next slide, and they're all pretty similar, these charts. Again, Ethereum, I don't like Ethereum, but again, we're looking at 1400, and I was told a parabolic sell here. And interestingly enough, I got taken out of it here around, looks like about 200. And now it's given me another parabolic sell on Ethereum, which is very interesting. I don't like Ethereum at all, but even in saying that, I wouldn't be selling something on its lows, even if I didn't like it, right? Because it has come a long way. And, you got to ask yourself, what's the downside to the top side? I don't like Ethereum as a cryptocurrency technology, but again, it has come down a very, very long way. But it's not my preferred cryptocurrency to buy, even for trading. If we go to the next slide, we've got VET, and again, VET has been smashed, but we can see that it's done a lot of basing, and again, the longer the base, the higher the rise, and that's pretty much the story. If we go to Tron, we were given a sell, and now it's given me a buy, which is very interesting. So, and it's given me a very solid buy, so I'm quite bullish Tron going forward. And I think, we could see a lot out of Tron. They're doing all the right things in terms of their blockchain and everything. So if we go back to, this is Binance. Binance, we were given a sell up here when the stock was around 26, sorry, the cryptocurrency was around 26 bucks. We're given a buy here, when it was under $1 or something. The bigger theme, then we were given another sell at $12. And, we still haven't been told to buy out of it on the bigger picture. But again, it's starting to base, it couldn't get below, $5 something. So, again, it looks pretty good. And I do like the exchange coins that are making a lot of money. So, markets overall, markets are connected by cash. When markets are imploding and going down, cash is king. There's no doubt about it. So, what happens when markets are going down fast? Investors and traders look to liquidate the most liquid of their assets first, because they need cash, to come up with margin against their trading positions. That's number one. So cash becomes king, and so they look to liquidate the fastest thing they can. Cryptocurrency, whether we like it or not in terms of the technology, is the fastest thing that they can liquidate if they hold cryptocurrency. If they don't hold cryptocurrency, the second fastest thing is equities, but they still have to wait for T+2 for the cash to come into the system, right? So that they can use that cash. So initially a knee-jerk reaction for all markets, and we've seen this with cryptocurrency, when equity markets come down, cryptocurrency markets will come down as well. But the reality is, cryptocurrency as an asset class should not be positively correlated to the equity market. And what I mean by positive correlation, if the equity market goes up, the cryptocurrency market shouldn't go up, it should be indifferent. And if the equity market goes down, the cryptocurrency market shouldn't go down just because the equity market's going down, which is a positive correlation. It should be indifferent, because it works on different fundamental, technical and different fundamental factors. So it should be immune to other markets. But as I said, the link is cash. Okay, so going forward, you might see a knee-jerk reaction to crypto coming down, but when people and traders and investors have come to their senses after they need cash, they'll realize that the cryptocurrency market is not correlated and shouldn't be correlated to equities. A matter of fact, it should have a negative correlation. So if equity markets are going down, cryptocurrency should be going up because the technology is good, or indifferent, or agnostic, whatever you want to call it. So it's really important to recognize that. And we are starting to see some separation from that. Like we started to see some separation of XRP and Bitcoin. XRP used to trade literally 1-for-1 with Bitcoin. When Bitcoin got smashed, XRP get even more smashed. Now we're starting to see a separation where Bitcoin was going down and XRP was going up, a negative correlation to Bitcoin, which is a great story, and that's what I would expect. So the themes also for this market, and crypto market particularly, and I will add that, is the correlation between different cryptos will change dramatically this year. So in other words, and I've said that before, if Bitcoin is going down, XRP should be indifferent to if Bitcoin is going down, generally as a rule, because the technology is different and it works better than Bitcoin. So in other words, rather than having a positive correlation, we should start to see things change their correlation relationship between other crypto assets. And I think that will be a huge theme this year. Absolutely. Anyway, if we go to our summary, so the risk, it's a risk-off trade as far as I'm concerned in 2019. I believe the equity market will continue to be sold. That's my personal belief. I'm not advising you for your own portfolios or anything else. This is just education. I'm not a financial advisor. My personal belief is that they will sell equities, absolutely. And obviously if the US sells down, every other market in the world sells down, the equity market that is. I believe they will sell foreign, the US against the yen, so the yen should do better. They will obviously sell the Aussie more against the US. As I said, the US gets a sneeze and we get pneumonia, or they get a cold and we get pneumonia. Again, they'll sell pound against US. Even though the US is going down, the pound will probably go down by more. They will buy Swiss, which is a risk-off trade, a defensive trade. The euro looks like it may go higher. They will buy all the risk-off currencies, being Swissy, yen, and Scandinavian currencies, and they will sell emerging market debt currencies vis-a-vis the US. They'll sell the Turkish lira, they'll sell the, the Venezuelan, whatever it is, they'll sell the real, they'll sell, the rupiah and everything else against the US dollar. Cash rates and bond markets, yields will tend to go higher. Initially, obviously, and then they'll start, as the equity market comes down, they will start to buy, cash rates and bond rates because they are safe haven and they're risk-off trades. If we go to next slide, we go to commodity markets, gold should go up because we've got inflation in the system, and oil should go down. And if we look at cryptocurrencies, initially, the knee-jerk reaction is because the market needs cash. They'll sell the most liquid thing, as I said, but then there should be a negative correlation to equities, okay? The cryptocurrency market, in my mind, I believe, my personal belief is this thing will go up this year. So, because I think it's been down for nearly a year and a half, and it's too much. And it gets to the stage where how far can you sell incredible technology, which is bigger than the internet? So there should be, going forward, a negative correlation to the equity market. So in other words, if the equity market's going down, the cryptocurrency market should at least be agnostic or, going up because it's got technology and runs on the board in terms of clients and partnerships. Anyway, I'll leave it at that, guys. Obviously, got the disclaimer here. This is education only. I'm not a financial advisor, whatever. I don't know your personal finance position, all that sort of thing. But if you do have any questions, please do come back to me. Thank you very much. And thank you all for supporting the business. And we want to be bigger and better this year. Thank you so much.